Welcome back, and we're joined by Gunjan Shah, Managing Director and Chief Executive Officer at Bata India, joining us. Hi, very good having you, Gunjan, because it was a 50-50 kind of quarter for you. You've got some bit of volume growth which has kicked in for you. Is it discounts which is driving that? Give us a sense of what's playing out, because some of your competitors have done relatively better. So what's playing out for you in particular?
Yeah. No, so I think you're right in a way. I think the top line has been the primary driver. That's been our focus area. We've seen sequential as well as year-on-year momentum on the growth front. We will want that to continue. It's also backed by volume growths, right? Which were a little lacking for some time, but they have now bounced back on the back of obviously multiple initiatives. I think even on terms of our, it's also shown that this quarter we had the highest ever full price sales of ours, right? From a contribution perspective, nearing almost about 85-90%. So unfortunately, we also had basically one-time adjustments that had to be done. One was a voluntary retirement scheme that we had launched in one of our units, in line with long-term strategy for efficiency and consolidation, as well as a forex restatement that we had to do on one of our agreements, and that because of the rupee fluctuation. So that did have an impact in the profitability side. But overall, I would say I think it was a volume-driven growth with the levers on, basically casualization, on premiumization, as well as significant expansion.
So you seem to be suggesting, let's unpack this a little bit. Firstly, on the volume count, you seem to be suggesting decent volume growth. And you seem to be also saying that discounts have actually tapered versus last year. Is that the right way to read the numbers? And is this sustaining FY27 as well in terms of how's the volume growth looking to sustain?
Yeah. No, I think both of these are critical focus areas. We've been working on this. Just to give you a sense, our inventory levels, the quality of inventory as well as the quantum of inventory, both have at peak levels of, and the quarter that went by. And I don't see that. We have put in structural levers in place. So I see that only increasing going forward, right? So that should only aid this whole thing of full price sales, and therefore the margin takeout that will happen. The discounting will be gradually only tapering further down. So all in all, I think it would be the way you mentioned, driven by obviously volume growth. We want to drive also parallelly. There is a very clear-cut push that we have also managed to see traction in the premium portfolio, and that will continue going forward.
Excellent. And with regard to gross margins, how are those shaping up for you? Is there raw material price inflation that you're penciling in at least going forward? I believe that margins for Q4 were quite resilient. Are you seeing that resilience going forward as well?
Yeah, we hope to maintain, and as I said, basically some of the efficiencies on inventory actually will flow through in terms of gross margins, etc., going forward also. However, there is an unpredictability on the disruption, geopolitical impact that will happen because of the crude oil and the rupee depreciation. We'll have to see how that pans out. As of now, I think we are in a good space, I would say. But the next 4 to 6 weeks, we will have to see how this gets stretched further, and if that has longer term impacts or not.
Okay, so not really sure, Gunjan. Is that how one concludes with regard to gross margins? Because you seem tentative on that count.
Sorry, can you just repeat the question?
With regard to raw material prices and gross margins, you seem tentative.
Yeah, so I think at the current state, I think we are pretty comfortable on our gross margins even going forward, right? The piece that, as I said, was tentative and which is a fact, right, is going to be how much this disruption geopolitically, which is impacting crude oil prices, where a lot of the inputs that go into our products are derivatives of crude oil, as well as basically the rupee depreciation, because materials are imported while we produce all our goods in India. But the fact is some of the raw materials are imported. So those implications we'll have to wait and watch. As of now, I think we are in a good space, is what I would say.
Point taken. With regard to, is there a guidance with regard to volume, or is there a target with regard to both volume as well as margins for the coming year? Some one-offs obviously impacted your EBITDA margins. But is there a thought process as to where that will lie for FY27?
We don't give forward-looking guidance, but however, I think the one-offs were one-offs, so I don't think they will repeat going forward. So as I said, I will maintain the statement that I said, that we seem to be in a good space. We want to push volume-based growth. We have seen that across our channels. We have also seen our largest ever expansion in a quarter. Last quarter, we added almost 50 stores. E-commerce and digital business, digital channels have grown in very, very strong double digits, right? So I think those are the levers that we'll keep pushing for. We also in the bargain, if I may just add, we also significantly amped up our marketing investments. We have been doing that now for almost 6 months or so, and that endeavor of ours will continue going forward. So you will see elevated marketing investments from our side.
Gunjan, hi, morning. Can you also give us a sense of the retail expansion that you want to undertake in FY27 and also a color on the same store sales growth that we've seen in Q4?
Right. So on expansion, as I just mentioned a little while earlier, is that we saw our strongest expansion in one of our in any quarter, last quarter, which was we added almost 50 stores. I think at that run rate, we should be adding in FY27 almost 200 stores. Our endeavor is to actually pick up a little more momentum on that. I see a lot of opportunity both in terms of tier 3 to tier 5 cities as well as the metros expand into the suburbs, etc. So there is a huge opportunity for penetration going forward also. We are almost on the verge of, or most probably, I think we have connected to having almost 2,000 EBOs across the country, which is one of the largest networks in the retail fashion space in our category. So that's where that stands. We don't share the like-for-like numbers, but we did see broad-based growth across our channels. So whether it be the Hush Puppies banner, the Bata banner, whether it's digital commerce, as I mentioned, or even in terms of our multi-brand outlets. So that we will want to keep on continuing, backed by volume growth.
How do you plan to, you spoke about the fact that, supply chain issues are there because you import quite a bit of stuff. How do you plan to mitigate that risk going into the next financial year? Is there alternate supply chain route you're looking at or alternate markets you're looking at for your materials?
Right. Just to clarify, we produce and manufacture all our footwear in India, right? So all our goods in India. But however, we do obviously import raw materials for that, right? And that does have an implication. We'll have to wait and watch on that front. As of now, I think we are in a good space. We have also pre-booked inventories, etc. But if this continues disruption for a prolonged period of time, then obviously we will have to put in mitigating measures, which we and the management team is working very strongly at. I think it'll be a combination of cost efficiencies, getting the right mix going in terms of premiumization and therefore protecting margins, as well as prices will have to get adjusted if it is prolonged for a long period of time.
You've done well where your cash flow is concerned, right, Gunjan, especially with regard to optimization of inventory. That's something you've done well. Is that a journey? Does that continue? Or with the stronger growth, that may take a bit of a backseat, FY27? What's the take?
Right. It's been a journey. It's been a journey going backwards. It will be a journey and a focus area even going forward. I think there is still scope in terms of how tightly we can manage the inventory while making sure that it's, the right inventory is available at the right places across our network, right? Which is, as I said, almost 2,000 now stores. Right. So just to give you a sense, I think year on year over 2 years, so right, 7, 8 quarters, our inventory has actually dropped by almost about 35-40%. Right. And it continues. Even last quarter was better than the previous quarter. Right. So it will continue doing forward. There is a structural program and a project that is put in place along aided with automation as well as, artificial intelligence based forecasting and planning tools. I think all of this will help us basically make sure that we are able to tightly manage inventory and therefore our ability to bring innovation from farm to fork much faster.
Gunjan, it's been fantastic talking to you. I know you're on a tight timeline, so I'll let you go on that note. I mean, we can keep chatting further, but thanks so much for coming in. Really appreciate it.
Thank you so much. Nice talking to you and nice talking to your viewers. Bye-bye.
Thanks so much.